Now, the International Monetary Fund has tempered expectations around India's $5 trillion target. In its latest report, it has now seen India getting close to $5 trillion dream only by 2028. Let's take a look at why the IMF made this claim. The IMF says India should cross $4 trillion in financial year 2026 and reach about $4.96 trillion by 2028. This is almost $200 billion lower than its earlier view. It has points to softer domestic demand and cooling inflation. Headline inflation may fall to 2.8% in 2026, which is good for households, but slows nominal GDP. Real growth stays strong at above 6%, yet the nominal gains do not keep pace. The bigger drag is the rupee. The IMF expects the currency to weaken to $87 in 2026 and 87.7 in 2027. Every step down makes India's dollar GDP look smaller, even if the economy is expanding well in rupee terms. The fund does not see a crisis but expects bouts of depreciation because of global uncertainty, tight financial conditions, as well as trade shocks. The IMF says U.S. tariffs and broader trade frictions are hurting exports and investment sentiment, as these pressures could keep India's output below potential next year. Its report also highlights that the impact may ease if tariff talks make progress. But the current baseline assumes the levies stay in place. The IMF also flags old structural weaknesses, labor rules, land access, and slow insolvency resolution, keeping productivity lower than it could be. Insolvency cases now take more than 700 days on average, and recovery rates have fallen. Private investment remains uneven, while public investment is carrying most of the load. High general government debt leaves limited room for a fiscal push. The IMF warns that India is operating in a tight fiscal box. GST and income tax cuts need close watching because they may squeeze the tax base. High debt levels mean the budget cannot be used to speed up nominal growth. The fund recommends steady consolidation, better spending quality, and stronger state finances. The outlook could improve if tariff talks with the U.S. move forward. The IMF knows that India does not expect the 50% levies to last and believes other markets can help offset the hit. The fund still sees India as one of the fastest growing major economies. It says digital public infrastructure, tax reforms, and a stable macro framework have boosted living standards and reduced extreme poverty.